Good evening, ladies and gentlemen, and thank you for being with me today. It's good morning to our friends along the east coast of Australia. Good afternoon to those of you across the ditch in the Shaky Isles. Well, I'm delighted to have you with me today, folks. We've got some really interesting stuff for you. Good to have all our usual supporters here. Albert's here with us. David, of course, 2 or 3 Davids. George, of course. Yes, here we are. Good. Well, you're all coming in late. It just keeps scrolling down. Here we are. Greg's with us. He's a money manager in Colorado Springs and Texas. Good to have you with us, my friend. Mr. Greg Palladini from California is with us. He's also a money manager. Danielcode tutorial guys. Greg Palladini actually has done the Danielcode tutorial twice. He became a Danielcode member in 2015, did a tutorial, I think in LA in 2016, and then came back last year to do another tutorial specifically to learn trading time. Now, Greg was a Forex guy when he came to me, and he still is. But having done the tutorial, he saw the joys and delights of also being able to trade futures based on the time signals, which he's done, and of course he's doing extremely well with all of that. Akhtar is with us, and good to have you with us, Akhtar. Greg, across the ditch in New Zealand. Hope your hand's getting better, mate. Broken hand sounds painful. Anyway, I'm glad you're with us. Jonathan, of course, a couple of Jonathans. Justin from the Hunter Valley is with us. His dad's been a long time Danielcode member. Terrific people. Louis is with us. Masao. Well, that's new. Good to have you with us, sir. Of course, Monty we know and love. Nathan, of course. Norbert up in the coal country of Canada. Steve, various Steve, lots of Steves. And Toddy over in California. I haven't seen you for a while. He's been a long time Danielcode guy as well. And, of course, Trevor, who's a terrific Danielcode supporter. And we appreciate having you all here with us today. So let's see what we can see. We're all running. I assume the volume's good. I assume you can all hear me. Somebody please type in questions that you can hear me over there around the world. Yes, no. Norbert, you're usually first. Here we are. Norbert, volume's good. Volume is, in fact, great. That's wonderful. Thank you, Norbert. Boy, it shows how long it takes. We're a long way apart, aren't we, my friend? And it takes a long time for this signal to get to you, even with the joys of modern technology. Anyway, let's move on. We have a whole lot to talk about today, largely based on the question of probabilities. Probabilities to the formal students of trading are all governed by the doctrine of random walk. In fact, in 2013, the Nobel Prize was awarded to 3 economists, one of whom was Robert Shiller, for their presentation, A Random Walk Down Wall Street, which basically holds that all stock market movements, and of course don't forget the derivatives that we trade in the equities are all just mirroring the stock market moves plus or minus a premium or a discount. But a random walk down Wall Street, described as the most thoroughly tested and best loved exposition of market action, holds that all price action in financial markets, the study was of the Dow, is random. And of course that's taught at every MBA course around the world, and people believe it. Regrettably, it's not true. And I've told you this before, but today I'd like you to be challenged to look at what I'm going to present to you and make your own decision. And if this statement here is right, that the Danielcode is a set of proprietary ratios that control time and price in all markets, it follows that the random walk theory cannot be right. So let's walk our way through this. I think you'll enjoy it. It's pretty challenging. In fact, I guess there's sort of nothing much more heretical I could say to folks who are educated in the financial markets by our esteemed universities and higher education around the world, because they all believe random walk theory. In fact, I may be the only person in the world who says that not only do I not believe it, but it's simply not true. Let's examine that. So probabilities generally are simply the chance that a specific event will occur. And I rate them 1% to 99%. But there is a mathematical a branch of mathematics that studies random events, and that calculates percentages from low probability to high probability, and they simply use from 0 to 1. But all of this goes on the basis that the outcome of a random event cannot be determined before it occurs, but it may be any one of several possible outcomes. Well, that's true, but what I'm going to show you is that these are not random events. These are events that are controlled and to some event foreseeable. I think I've got that here. We've got lots of people coming in late today. So the easiest way to consider probabilities in a non-scientific way is the story of the 500 monkeys. That's an old story that if you lock up 500 monkeys with 500 computers for an infinite period of time, one of them will eventually type the Bible. And basically it's a play on the fact that you get enough random events, they may start to look like they're persuasive, but in fact they're still random. That won't be a challenge to what I'm going to show you because of the depth of data that we have. And you can start with looking at our chart archive under the Danielcode website, and you'll see over 45,000 Danielcode members charts that I've created since 2008. All of these are just automatically filed under the Chart Archive tab with a suitable delay to protect our members' interests. So the basis of trading markets is a little bit hard to get your head around, because you start with the juxtaposition. That is true. I do not know what markets will do tomorrow. Nobody knows that. Anyone tells you they do, I suggest you run far away. But here's the juxtaposition. Trading requires that we trade to optimize the probabilities of the future. Now, they're not quite the same thing. But as I've told you, a Nobel Prize was awarded in 2013 for random walk theory that opined that all market moves were entirely random, and that the stock market, and therefore derivatives, moves in a completely unpredictable way. In my view, that's simply not true. And I want to prove it to you today. In fact, I want you to prove it for yourself. And as I say, anyone who's ever done a doctorate or a business degree of any sort has been taught and believes random walk theory. As I say, it's always described. Wikipedia, Investopedia, Britannia, Encyclopedia Britannia, anything you like of the notable and trusted text described it as the most tested, most thorough, and entirely comprehensive description of how markets really work. Remembering that work was done on the Dow. So everyone has swallowed the Kool-Aid might be the best way of telling you, that I opine that that is simply not true. Anyway, let's work our way into it. Some old market law is worthwhile. The trend is your friend. Trending markets will not correct more than 3 days. That's another one, but they do require some qualifiers. The trend is your friend until it ends. trending markets will not correct more than 3 days. Actually, that should be 4 days, not counting inside bars. And in fact, there are many different types of corrections that once it gets past the simple version that we're talking about here, you're not going to be able to see them until they've happened. W.D. Gann said there were 12 correction patterns, and I'm sure he's right. Inside bars, folks, are a law unto themselves. I could talk to you for a whole day or so about inside bars. They can be nulls, or they can be signposts to future price levels. So we're never quite sure with inside bars exactly what they're telling us. But we managed to overcome that by using some management. Here's some new market law. A daily close above the Danielcode black line creates a huge probability that the old high is breached. I've told you that on many occasions, most recently July 2020 in a Danielcode webinar when we were specifically talking about gold, and gold had moved up to the famous Danielcode black line. And I told you at that webinar that a daily close above that black line meant a very high probability the old swing high would be taken out. And that was a $26,000 trade as it turned out. Nothing particularly original. Well, it was original, I was going to say. The idea that the DC black line behaved in a different way is something that I should talk to you about a bit more. All of the lines in the Danielcode retracement tool, the red lines, they work in the normal way, that they're simply support and resistance. The black line is different. It works not only as support and resistance, but on a closing basis, it gives you a very high probability that if it's taken out, the major swing that it's tracking will be breached and taken out. So, as I say, not a huge amount of money in that one trade with gold, but it was a nice trade, and you'll see this happening all the time. So be aware where the Danielcode black line is. Interesting having Akshay with us today, who's an Indian gentleman. He been a Danielcode member for a long time, and he uses Bloomberg data. And he told me that soon after I released the details on the Danielcode black line, way back in about 2009, he said the Bloomberg rep had come to the firm where he was working at the time and said, "Oh, here you are. We've worked out some new a new support and resistance level for you, and if you multiply this Fibonacci number by that Fibonacci number, and add on the number of tiger's ears you can see in the jungle and deduct your age," or something, I'm being facetious. Lo and behold, we have a number that's very close to the Danielcode black line. So he didn't say it was close to the black line, but in fact they mimicked it. Tech guys worked out long ago it's much cheaper to steal something than to invent it. But anyway, I'm sure Bloomberg had an original take on all of that. Here we are. Okay, so markets repeat ranges. One of the things you need to know is that all market moves are fractals of previous market ranges. And if you follow our success program, you'll have seen this. They're incredibly accurate. Coffee last Wednesday was a case in point. Both the S&P Emini and the Russell today return equal ranges. That is equal to previous ranges. In other words, fractal moves repeat. And as the Danielcode retracement ranges are fixed as percentages of any range, they can't be changed, but they adapt to fit any range. So have a look at this chart. This is a chart that I use when I'm teaching people doing the Danielcode trading tutorial. And this is from 2015. It's the COMEX gold chart, daily chart. And you can see from that significant low in July that we had two swings. We had a minor swing and a major swing. And the numbers you can see on this chart are the Danielcode ratios, first of all, of the minor swing. They're the ones closest to the chart bars themselves. And the next set of numbers you see, they're the major swings. And have a look at them. 3 of the 4 are absolutely on top of each other. And the 4th has a difference. It looks like it's got a bit of space between them, but it's only got a space of less than 1 point. I mean, it's just incredible how accurate these bars, these Danielcode ratios are. So does that tell you something? Does that forecast you something about price movement? Sometimes. The whole rally up from the early August, late July, early August low up into the late October high was stopped by 2 of the Danielcode retracements. And those retracements were 89% of the minor range and 74% of the major range. And they were right on top of each other. And that happened. One was 1190.8, one was 1191, so 2 ticks variance. That's all you're talking about. Does this happen often? Happens all the time, because all market moves are fractals of previous moves, or previous ranges, I should say. So where are you going to find real support and resistance? These are vital elements in trading, but most folks don't know what real support and resistance is. They see many charts with faux trend lines masquerading as support and resistance. Moving averages are much favored by commentators who constantly get excited about where they are. The only real support and resistance you will ever see is old highs and lows on daily charts and the Danielcode ratios on all time frames. Can I prove that to you? Absolutely. So let's first of all look at the high probability strategy. The highest probability I know of in Futures and Forex, and I've been doing this for over 30 years, is that markets react with great precision to the Danielcode red and black lines, which are the retracement ratios, and that applies to all time frames. Secondly, all markets react and acknowledge the Danielcode blue lines, which are extensions of previous ranges. If you don't know what I'm talking about, do please get yourself a free trial of the Danielcode website and look at the members' charts. I put in an enormous amount of work producing those members' charts, and they're absolutely stunning. If you don't know these numbers, and you don't know that markets will react to those numbers, you're honestly missing the biggest part of trading. The Danielcode ratios is the one thing that's entirely new in trading. It's proprietary to Danielcode and members. Very, very few people know what they are. We're a very small business. But the accuracy of these numbers will stagger you. So in the Danielcode lexicon, target recognition occurs at a bar high, a bar low, or on the close. If the market's rallying, it'll be the bar high or a close. If the market's retreating, it'll be a bar low or a close. And it's valid sometimes for a number of days, but it is limited to 0.1% variance, 1/10 of 1%, and usually it's much less. Sometimes it's a handful of ticks. So the problem with commentary, if you're interested in trading, you're deluged with commentary from a huge number of sources. Some of this is from the best and the biggest in the business, the famous names, the famous trading houses, Goldman, JP Morgan, the rest, Nomura. Almost all of it is self-serving or talking their trade. So this current rally in the S&P, Goldman and others didn't buy the current rally. So the hedge funds, who all take their trading advice from the same few sources, including Goldman, JP Morgan, and Nomura, etc., they've missed the current rally altogether, and they're said to hate this rally. Simple answer to that, they simply do not know how to trade. Do you think that's heresy? You be the judge. You didn't miss the rally. You certainly got the rally. You're certainly currently in the rally. And Vicky's joined us. Lovely to have you with us, Vicky. Rolf's joined us. Good to have you with us, Rolf. Monty, of course. Louis, I know we've said hello to him. Jonathan across the ditch is with us. Yes, the two Gregs through with this bill, plenty of those. Adrian down in Adelaide. Long time since I've talked to you, Adrian. I'm delighted to have you with us. I hope your family are well, my friends. Okay, so to argue from the micro to the macro is false logic. You can't do that. We must always argue from the macro to the micro. So that means that we're going to have to take a trip down the macro lane and see what if I can prove what I'm talking about. So first of all, what tools work on all markets all of the time? The Danielcode ratios, as used in our Danielcode retracement tool, is made up of 5 ratios from Daniel's code, 2 ratios from the rule of 8, which itself comes from Daniel's code, 1 self-selecting ratio from the rule on time progressions. These are all ratios in time, but we use exactly the same ratios to define price. And that's because time and price are the same thing on different axes. You look at our chart archive tab and prove that to yourself. Now, to most formally trained trading people who are thinking that random walk is the basis of markets, this stuff will sound crazy, but it's a fact. But if you're going to make huge statements, and this is a huge statement, you've got to be able to prove it. So that's what we're on our way to doing. So the basic Danielcode hypothesis is that the Danielcode and the rule of 8, which, as I've said, is itself, the rule of 8 comes from Daniel's code. And it's been used extensively for many, many years. Back in the day, all stocks were quoted in 8s. Today, grains are still quoted in 8s or 2/8, actually. They're running quarters. UST bonds, 32 ticks to the points. That's 4 lots of 8. That's how they got to it. And markets are ruled by that. And more than that, markets, this will shock you, are trying to talk to you. Literally, markets are trying to talk to you. The vast majority of folks are not listening. Markets constantly demonstrate that they're ruled by the Danielcode by their reaction to known price targets. I've been accused in the past of putting on so many numbers that it must hit 1, said a friend of YIKES one day. It's not the number. Sometimes if you get a really long run, and the blue lines in particular, they're created from every swing, the matrix of every swing. They just keep creating more and more blue lines. You finish up with a whole lot of them. But that's not the point. The point is that to be elected, as we call it, or well, first of all, for the target recognition to occur, either the high or the low, depending whether it's a rally or a pullback, or the close has to be within 0.1 of those lines. And as I say, often enough, it's a matter of a handful of ticks, quite literally. So that's the Daniel hypothesis, which is the exact opposite of random walk theory. Markets, are chatterboxes. That's an old expression you might not have heard for a while. They're talking to you almost all the time. The purpose of derivative markets is to reward those that understand, and few do. Markets have always tried to talk to us. The problem was that before we had the Danielcode, we didn't have the language to understand them, but now we do. And honestly, this is what gets me up in the morning, folks. I've been doing this for 30 years. That's derivatives. I traded stocks with my father before that. He was a great man for the stock market. But after all that time, I'm always excited to see what markets had to say today. And I'm deadly serious about markets talking. And I can teach you their language, and I'm going to show you a little bit of it today. Have a look at this. These are 4th and 5th seal lines on the S&P Emini, and they're pretty staggering. As part of if you decide to do a tutorial, I'll be happy to teach you all this stuff. In fact, the Danielcode tutorial, I will teach you everything you see me do at these webinars. This is the S&P Emini again. And that's how the high came in January 2022. Now, in truth, there are many of these lines. And if you simply put them all on a chart, you'll finish up with a spider web. too much data. I have to keep my charts clean. I don't want too much data because it finished up becoming conflicting. But simple enough here, you can see that's the fourth seal line into the tagged the high pretty much to the tick. It also tagged the penultimate high before the high. And the other one, the lower line, that's also a fourth seal line, and it's tagged the low of this rally pretty much, this pullback, I should say, pretty much perfectly. Now, keep looking at the top of these charts because we're using different periods. This is a 6-day chart, which is the basis of our long-term chart, for which we use 6, 12, and 24-day charts. And using the longer-term charts, we're looking at far bigger ranges. So the DC price targets are much farther apart. This makes the test of my hypothesis harder by actually many degrees. So it's a good chance for the naysayers, and I know there are always naysayers around, to check out the spacing of the DC ratios and hence the probabilities of the markets finding them with the degree of accuracy that we require. Let's see what we've got there. Here is a start. This is the S&P Emini. And this is the macro. This is a 6-day chart. Each of these bars encompasses 6 trading days. The accuracy of this should be to plus or minus a fairly substantial variable, because how the 6-day bars are created depends entirely which version of Trade Navigator you got, or any other data that you happen to be using, and the starting date of the data that you've got downloaded. So if your data starts from a different date, your 6-day bars will be slightly different. However, I can do this on 3 different computers with 3 different starting dates and get exactly the same result, which was why you're seeing this. So this is the minor swing that it's correcting. The major swing goes down to March 2020 in this piece of the chart. Have a look at the pullbacks. There's 1, 2, 3, 4 of them that we find. We have target recognition at the red line, then again at the next red line, and it skips a couple and goes down and hits another red line, and then the outside bar just drops to the next red line and reverses, and off it goes. So what happened at the low? When we look at that, we say there's no support there. Well, that's because all we're talking about at this stage is the minor swing. And what happens here is the market switched to the major swing, which is something it does all the time. Is that less accurate? No. That low came in at 36.39. Where's the Danielcode number? 36.36. 3 points difference on a 6-day chart. Absolutely extraordinary, isn't it? Ever think about that? Then have a look at this. The variance from the target of the 5 lows varied from 2 points to 12 points. This is on a 6-day chart. The maximum variance from target at 12 points is 0.28%. As I say, remember, this is a 6-day chart. If it was a daily chart, we would require target recognition within 0.1%. Now, that looked pretty impressive, didn't it? So was that a happenstance? Well, let's have a look at the other equities. In fact, let's make a real meal of it and have a look at all of the other equities. This is the Dow index. Both the index and the futures are valid. And you can see where Dow gave target recognition, 29927 on the close, compared to the Danielcode red line at 29925. 2 ticks, 2 points variance, 1, 2, out of a market trading at 29,000, close enough to 30,000. What's that as a percentage? Nothing. It's not even a hair. This stuff is so accurate it could scare the pants off you. It really should. Let's have a look at the NASDAQ. It's usually thought of as a pretty wild and woolly beast. So this is a 6-day chart. This is the NASDAQ index, not the futures. Both are valid. And here you are. What caused the current low in the NASDAQ? Danielcode black line of the minor swing. 11,023 was the black line. Terrific, isn't it? This market continues to go down. What are the next lots of targets to be? Well, there's 3 of them sitting there, right there. And there are more. What about the Russell? You're now talking about entirely different markets. No relationship surely between the NASDAQ and the Russell, is there? No relationship between the S&P and the NASDAQ or the S&P and the Russell, is there? Of course there isn't. These are entirely different indices. They are made up of an entirely different groups of stocks. NASDAQ, the big banging high-tech stocks. Russell is the small caps, the most inoffensive market in the universe of stocks that are publicly traded. However, charts don't look anything like each other, do they? But look what happens on the retracement. First move down, Danielcode target recognition around 1890, plus or minus a handful of ticks. Next one tags the 1701 line, plus or minus a couple of ticks. What about the very bottom of it? The close, remember target recognition is valid of the bar high low or the close. The close of the low here was 1665.70. Where's the Danielcode number? 1660. 5 points on a 6-day chart. You got to be scratching your head if you don't believe this stuff. Let's keep going. This is Germany's DAX, which should be a complete outlier, but it's not. In fact, Gann's Delight, I've called this chart. Any of you who've studied W.T. Gann will love this. Time and price were squared at the high. We had a 62 cycle from the outside bar to the outside bar high, and the low came in at a 62% retracement. Time and price are squared. Isn't that wonderful stuff? I love it. Happens in markets all the time. Okay, what about Bitcoin futures, guys? I know no one here's a Bitcoin fan, but I've certainly had students say to me, the most volatile market in the world at the moment is Bitcoin. I think that's pretty right. Look what happens when you put the Danielcode retracements on. And this is the Bitcoin futures chart. We don't even have full data on this. It is a fairly recent beast. But if you simply use the Danielcode retracement tool, 20210. This is target recognition at the low. Yeah, in fact, you have, don't forget this is a 6-day chart again. You have 3 bars, that's 18 days, 18 trading days, nearly a month. A month is 22 trading days. Nearly a month of the closes all at 2010. It wants to make sure that you weren't misled. That's proper Danielcode support. Does that mean that's the low? No. It means it's a low for the time being. There may be another low. Who knows? We'll know when we get there. But what we do know is the next low will come at a Danielcode ratio. So what about gold? Have we gone far enough to convince you yet? We've gone through 4 of the US equities. We've gone through Germany's equivalent of the S&P. What about gold? Well, this is the pullback from the August 2020 high, showing you where the minor retracement minor swing is. Look at it. 1678 was the Danielcode ratio number there. 1, 2, 3, 4, 5 gold bars sitting right on it. The first of them, back in February 2021, gets it on the close. All of the others get it at the bar low. Excuse me. It's morning in beautiful Queensland, and Occasionally I do get a bit of hay fever, so forgive me, folks. That will go. Equally, you might think I'm choking up with the excitement of these charts. And they're incredible. How many have we done now? How many more would you like? It works all the time. All markets are ruled by the Danielcode ratio. I know that sounds silly. Here it is. Pick another one. What about copper? Okay. This is the pullback from the March 2022 high. Where did it stop? Right at its Danielcode ratio of 312. And I've got an arrow pointing to the side, but I hadn't realized that this program does not show you the surrounds. It's actually pointing, those of you who've got Trade Navigator, to the Danielcode retracement tool, which is our motto, our mascot, I should say. That's Dan the Hedgehog. But we include this Danielcode retracement tool, which is creating all of these levels that you see. We include that as part of your Danielcode Pro website subscription. So if you'd like to have that tool, and honestly, if you don't have it, you're missing out on the best invention since someone said random walk theory was true, and it's not. Okay, so we throw that in as part of your subscription. It's a wonderful, wonderful tool. You use it every single day. What about Forex? Don't forget, Forex is more than half of our trading markets. We started off as a Forex business. I love Forex trading. And have a look at this. This is the British pound, US dollar. I know most of you guys are only interested in the majors, which means you're missing out on the most volatile of the markets. But here, this is a huge, huge market. Look what happens in the pullback from June last year. DC target recognition at 3186. Next move down, target recognition 12987, plus or minus a handful of ticks. Look what stopped the next bar down, 12831, stopped exactly on the Danielcode number. Then it broke through and it went further, down to 12145. That caused a key reversal bar that caused a little rally. What happened at the low? Early turn. It's not much and it's not significant, but that early turn comes in often and signifies a rally is building. Okay, you can get a good hint of that by the way in which the markets react to the Danielcode numbers. Sometimes they'll go a bit early. That's always a sign that the contrary move is there and in play. That's very well worth knowing about. So how does this happen? How all these markets stop at Danielcode numbers? Well, essentially it's group psychology. Nobody wants to sell anymore, that's the low. Nobody wants to buy anymore, that's the high. But when you think of the number of people and institutions who are trading these markets, I mean, when we talk about equities, we're talking about massive markets. When we talk about gold, when we talk about copper, these are massive markets. There are, I don't know how many hundreds of thousands or millions of individual traders there are. And as well as that, you've got the index guys, you've got the arbitrage guys, you've got ETFs, you've got warrants, you've got anything you can think of. And they all have such different interests and different methods of trading. You won't find two traders, or you shouldn't be able to find two traders who say they're trading the same program. But with that huge, huge variety, it literally is out of the leaves on a tree. Go and have a look at a forest, count the leaves. That's how many people trade these huge markets. But they all trade the same way according to the levels created by Daniel's code. And that is a miracle. You couldn't describe it as any form of logic. You tell anyone that statement I've just made to you, that all traders have been cloned, whether they like it or not, including me. It's true. How else can we have those markets, which you've just seen, massive, massive markets, all turning at the same place? It's extraordinary, isn't it? So that was the macro. Let's go to the micro. This is a pretty little picture that Microsoft conveniently popped up on my screen as part of their latest upgrade. So let's go and look at the green shoot. This is the actual members chart of the June low. And it was around Juneteenth, the holiday. Have a look at that. The low of this bar, which was the June low, 3639, 2 points variance. Incredible, isn't it? It's what happens all the time. That's target recognition. And here this is for you. The most hated rally, as zero hedge describe it. Goldman didn't buy it. Zero hedge didn't buy it. JP Morgan didn't buy it. Nomura didn't buy it. Why not? There's 1, 2, 3, 4 buy signals in that whole spell. There's also 1, 2, 3 sell signals. And it all started with correlated TO3 buy at the blue line at 36.41. 36.41.50. I'll give you the exact number. You give me a moment. Here we are. Let's have a look. See what the Book of Words has got to say about it. Here it is. The low of that bar was... Let's crunch in a bit more data here. See if we can get this for you. Just about there now. Here it is. This is the low. The low, June the 17th. 3639 was the low. 3641.50 was the Danielcode blue line. Amazing, huh? That's what it does. All the time. That created a correlated TO3 buy signal. We had buy signals in the NASDAQ and the Russell. Sometimes these markets won't create their own signal, but they are so highly correlated, as you know, that a signal in any one of the US equities and Germany's DAX can be executed in any other of the correlated markets. So if you're a NASDAQ guy, you can execute the S&P buys and sells in the NASDAQ, or the Russell buys and sells, or the Dow buys and sells, provided the trade is elected. That's what that level of correlation means, and I talk to you about that pretty regularly. It's an amazing thing. When you understand this stuff, it is also simple and obvious. Markets are talking to you. Now, that sounds really silly, doesn't it? This is our latest 6S trade, and was also a TO3 trade, and this is natural gas. And it gave us a wonderful rundown. Look at this run up. Right at that low, we had a TO3 buy signal for natural gas. The market was talking to you. What was it saying? It was a handful of ticks off the 5333 blue line level. It was saying, I know these numbers and I'm tracking them. Look what happens from there. Up it runs. The high gets stopped at the minor swing retracement. It's talking to you. What's it saying? I know these numbers and I'm tracking them. One little bar down as a result of that, then next bar up. I haven't put a tag on it, but you can see for yourself. I know these levels and I'm tracking them. 2 bars later, it closes right on that Danielcode red line retracement. That's a correction of the minor swing. I know these numbers and I'm tracking them. Watch what happens once it gets into the blue lines. Up it goes into the 7576 number. I know these numbers and I'm tracking them. Inside bar, largest bar that gives us nothing. Small bar straight over. Why is that there? That's the market's, excuse me, that's the market's way of saying, oops, sorry. It's hit the the blue line at 8039 precisely. That's the market way of saying, I know these numbers and I'm tracking them. And this typically happens every second or third bar. After that bar, we get a bar that doesn't give us any target recognition, but 2 days later, it hits the 8714 blue line. Almost exactly. Market's talking to you. What's it saying? Saying, I know these numbers and I'm tracking them. Then we get this little blow-off high into the 8389 blue line. And what's happening there? The market's talking to you. It's still saying, I know these numbers and I'm tracking them. It's also saying, this is a setup for a TO3 sell signal. This is target recognition. Absolutely perfect. 28,000. Actually more on the front month. There was a rollover in there, so I had to use the 057 chart to demonstrate it. Actually did better than that. It's enough money anyway. What the hell are we talking about? 28,000 in 4 trades. Great stuff, isn't it? Sugar. Not many of you trade sugar, which is a shame, because it's got a reasonable, I say reasonable, in question marks or inverted commas, because it's on the ICE exchange, and folks, including some brokers I know, simply won't pay for data on another exchange. When I started covering this market, it had a margin of $500. Usually it sits around $1,000. Recently it's just popped up to $1,500. Now, those of you who've been with us for a while and who follow these Danielcode webinars will remember that a few webinars ago I gave you an analysis of the major markets on the CME exchange and the major markets on the ICE exchange, which is the US dollar index, sugar, and coffee. And the way they calculate margins at the ICE exchange is totally different to how they do it at the CME exchange. And the margins are massive compared to the average daily range, which is what you should be looking at. So by definition, it won't reward you as well as a percentage of margin, but it's a particularly good trading market, and coffee, I venture, is one of the best markets that we have. But have a look at this. What happened at the high? DC target recognition. The market is talking to you. What it was saying was, I know these numbers and I'm tracking them, and this is a TO3 and a blue line sell. Now, the blue line buys and sells are the strongest of all the signals. They don't appear very frequently. When they do, it's a probability that you're going to get a trend change as well as the signal. So the TO3 and blue line sell signal right at the high of that whole rally up. Down it went. Remember, margin was at 1,000. Now I think it's up to 1,400. Made $1,800 just in the one push down. Now, 110% of margin is always nice. As I say, it's a shame this market isn't traded on the CME. As it goes down, it gets down to the bottom blue line, the market's talking to you again. What's it saying? It's saying, I know these numbers and I'm tracking them. And it's also saying this is target recognition. And it's also saying this is a TO3 and a blue line buy signal, which gave us the trade up to today's close. So, don't forget, folks, there's many sources of information you need to be aware of. One of the most important is the Fourth Seal commentary by Frank D.B. Those of you who are new to Danielcode may not know, Frank is a Belgian gentleman. He's a farmer and farms his own property there. He's the most delightful person you could ever meet in your life. He came out to Taupo, New Zealand, where I was having a tutorial in 2011. He was a young man then. He's probably still, well, obviously he's a young man now. Everyone's young compared to me, but Frank was a very young man. And he bought his fiancée, Anne. They're married now, 2 beautiful children. But he came up to me and said, I've never seen a financial chart. I don't know anything about financial markets, but I like your writing. At that stage, I was writing mainly for Financial Sense over on the West Coast there. Frank came to that tutorial. It was the first time I'd ever taught the Fourth Seal. And he got particularly interested in it. In fact, it's fair to say he dedicated himself to it from then on. So he's now a very, very experienced guy. He's got 10 plus years of sweating over his Fourth Seal charts in S&P, S&P gold, I should say, and crude oil. And he's very good. And you'll be absolutely amazed when you read his stuff. And right now, this is the latest one. And you really do need to know what longer-term cycles suggest. So, as I say, Frank also covers gold and crude oil, but get yourself subscribed to the Danielcode, and you can subscribe to the Fourth Seal, any one of the markets, or all of them, whatever you wish. It really is a much, much longer term at market movement, but it's completely valid. Okay, let's move on and see what we've got. So what we've been doing mostly today is showing you the Danielcode retracement tool. It's much simpler to explain and to demonstrate. And in addition to that, we have the blue lines, which are extensions of the range. The red and black lines on the Danielcode retracement tool are retracements of the operating ranges. So if you liked it, and you should, get subscribed to the website Pro package, the Danielcode. We'll include the Danielcode retracement tool and the Danielcode time tool in your package. It's $249 a month, which is about $11 a day. You think it's worth it? One trade like the recent nat gas trade will pay for about 8 years of that subscription. Or use any of our service subscription packages. They're all listed under our services tab, and we have many different ones. Any questions or queries, let me know. Write to me and I'll be happy to enlighten you or assist you however I can. Or better still, take the Danielcode tutorial where I teach you everything you see here. Excuse me, and much, much more as well. So if you want to be a super trader, folks, join the elite. Email me, jneedham@thedanielcode.com, with your details. Happy to discuss the Danielcode tutorial with you. I should tell you that my fee for the Danielcode tutorial is $7,500. If you have the money, take the tutorial. It's the best thing you could possibly do with your life right now. If not, use one of our other subscription services at the website. We have product groups there that will suit any pocket. So remember, the business of trading futures and Forex is not to be right. The business of trading is making money. That's what we do, and that's how we measure ourselves. And if you haven't already, folks, please have a free trial of everything the Danielcode. Just go to our website, www.thedanielcode.com, and log in. Just follow the prompts. Any problems, contact Terry at support@thedanielcode.com. If you've had a previous trial, the website will remember and may not want to give you another trial. If that's the case, contact Terry, and he can fix that up for you. Finally, this is our disclaimer. I do really suggest that you read it carefully. I know all this stuff is like blah, 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 and you skip through it. I can assure you that if you don't know how to trade, it is really, really easy to lose your money. 90% of traders lose their first bank in the first 90 days. That's the generally accepted rule. I reckon they lose their bank in the first 30 days, sometimes in the first hour. Learn to trade, and then it's really easy to make money. Just as easy to make as it was before to lose. The difference is your level of knowledge. For goodness sakes, don't trade real money until you are absolutely confident that you know what you're doing. If you'd like to learn about trading, do let me know. I'll be happy to offer you the Danielcode tutorial. Apart from that, go to the Danielcode website. There's masses of material there. In fact, there are plenty of guys who say, if you just read the comments in forum, it's a self-teaching course. I don't think that's absolutely right, but close enough. T-bonds and the DX index. Actually, no, nothing important, but we do have a blue line sell on the T-bonds for today, and I do expect US dollar index is not far off staging a rally. So thank you for being with us, folks. That's us for today. I'm delighted you were with us. I hope that there's plenty of material there for you to think about, and it should be. It's a whole lot of rather brash and outrageous statements. I'm confident that we proved the case. I hope you are too. Thank you for being with us. Bye-bye for now.